The allure of the Indian stock market, particularly the Nifty 50 index, is undeniable. It represents the pulse of India's top-performing companies, offering a gateway to potential wealth creation. However, like any significant undertaking, venturing into the Nifty requires a well-defined strategy and a systematic approach. Think of it as managing a project. You need clear objectives, a detailed plan, resource allocation, and diligent execution. This video serves as your comprehensive project plan, breaking down the seemingly complex process of getting into the Nifty into manageable steps. We'll use simple language, avoiding jargon and focusing on clarity, making it ideal for beginners and those seeking educational insights. Phase 1. Defining your project scope and objectives. Understanding the Nifty. Before diving in, it's crucial to understand what the Nifty truly represents. What is the Nifty 50? Imagine a carefully curated team of the 50 largest and most actively traded companies listed on the National Stock Exchange of India, NSE. The Nifty 50 index tracks the collective performance of these companies, acting as a benchmark for the Indian equity market. It's not a place where you directly get into like a physical location, but rather an index that reflects the overall market sentiment and performance of these leading entities. Why focus on the Nifty? For beginners, understanding the Nifty provides a broad overview of the Indian economy. Investing in companies that constitute the Nifty often implies exposure to well-established and relatively stable businesses. Furthermore, numerous financial products, like index funds and ETFs, are designed to mirror the Nifty's performance, offering a diversified entry point. Defining your investment objectives. Just like any project needs clear goals, your investment journey requires well-defined objectives. Are you looking for long-term capital appreciation, regular income through dividends, or a combination of both? Your objectives will significantly influence your investment approach. 1. Vishjayan.com. Vishjayan.com. Assessing your risk tolerance. Every project has inherent risks. Similarly, stock market investments come with the possibility of losses. Understanding your risk tolerance, your comfort level with potential fluctuations in your investment value, is paramount. Are you a cautious investor who prefers stability, or are you comfortable with higher volatility for potentially higher returns? Phase 2. Planning your resources and infrastructure. Setting up your investment framework. Now that you understand the Nifty and your own objectives, let's lay the groundwork for your investment activities. Obtaining a PAN card. This is a fundamental requirement for any financial transaction in India, including opening a Demat and trading account. Opening a Demat account. A dematerialized account, Demat account, is essential for holding shares in electronic form. Think of it as a digital locker for your investments. You'll need to choose a depository participant, DP, which is an intermediary that provides Demat services. Several banks and brokerage firms offer these services. Consider factors like fees, customer service, and the platform's user-friendliness when selecting a DP. Opening a trading account. A trading account is linked to your Demat account and allows you to buy and sell shares on the stock exchange. Often, the same entity that provides your Demat account will also offer a trading account. Completing KYC, Know Your Customer, procedures. This is a mandatory process to verify your identity and address, ensuring compliance with regulatory requirements. You'll typically need to submit documents like your PAN card, address proof, and photographs. Understanding brokerage charges and fees. Brokerage firms charge fees for facilitating your trades. These can vary depending on the type of brokerage plan you choose, e.g., percentage-based or flat fee. Be transparent about these costs to factor them into your investment decisions. Setting up your banking infrastructure. Link your bank account to your trading account for seamless fund transfers for buying and selling shares. Phase 3. Executing your investment strategy. Choosing your entry point. With your infrastructure in place, it's time to consider how you want to participate in the Nifty's performance. Direct investment in Nifty 50 stocks. This involves researching and selecting individual stocks from the Nifty 50 index based on your analysis. This approach requires significant time, effort, and expertise in fundamental and technical analysis to identify promising companies. It offers the potential for higher returns but also comes with higher risk and the need for continuous monitoring. Investing through Nifty 50 index funds. Index funds are a type of mutual fund that aims to replicate the performance of a specific index, in this case, the Nifty 50. When you invest in a Nifty 50 index fund, your money is diversified across all the constituent stocks of the index in the same proportion as their weightage in the Nifty. This offers instant diversification and typically comes with lower expense ratios compared to actively managed funds. Investing through Nifty 50 exchange-traded funds, ETFs are similar to index funds but are traded on the stock exchange like individual stocks. They offer the benefits of diversification and typically have even lower expense ratios than index funds. You can buy and sell ETF units throughout the trading day at prevailing market prices. Systematic investment plan, SIP. Regardless of whether you choose direct stocks, index funds, or ETFs, a SIP is a disciplined approach to investing a fixed amount of money at regular intervals, e.g., monthly or quarterly. This strategy helps to average out your purchase cost over time, mitigating the risk of investing a large sum at a market peak. It's a particularly effective strategy for long-term wealth creation. Phase 4. Monitoring and controlling your investments. Staying on track. Just like a project requires regular monitoring and control to ensure it stays on track, your investment portfolio needs periodic review. Tracking your portfolio performance. Regularly monitor the performance of your investments. Understand the returns generated and compare them against your initial objectives and relevant benchmarks, like the Nifty 50 itself. Understanding market dynamics. Stay informed about the factors that influence the stock market, including economic indicators, government policies, global events, and company-specific news. This will help you understand the reasons behind market movements and make informed decisions. Reviewing and rebalancing your portfolio. Over time, the allocation of your assets might drift away from your initial plan due to varying performance of different investments. Periodically review your portfolio and rebalance it by selling some overperforming assets and buying underperforming ones to bring your asset allocation back in line with your risk tolerance and investment objectives. Staying informed and educated. The financial markets are constantly evolving. Continuously learn about different investment strategies, financial instruments, and market trends through reputable sources like financial news websites, books, and educational resources. Phase 5. Risk management and contingency planning. Preparing for uncertainty. Every project faces potential risks. Similarly, stock market investments are subject to volatility and market fluctuations.